Well, greetings and welcome to the February 2024 Investment Strategy Brief. In this episode, we want to focus in on artificial intelligence, kind of the boom that's happening, and really visit the idea of whether this is kind of temporary, what's going on, or whether it's enduring. Now, recall that we published at the beginning of the year our outlook, which we called Embracing Change. And artificial intelligence has a lot to do with what's going on. To start, when we look at the markets, recall that we had a forecast at the beginning of the year on the S&P 500 to end the year at 5,000. And honestly, we've already hit that, so it's only February. It does beg the question, what's driving that? We'll get to that in a moment. But we know that it's centered to a good degree on enthusiasm about AI. So we'll get in a little bit deeper. But then as it relates to interest rates, basically we see the 10-year range bound at the end of the year, towards the end of the year of 3 3/4 to 4 1/4. Again, it's mostly been in that range so far, but has topped off just a little bit above 4 1/4%. So again, that's sort of what we're seeing in terms of the influence of AI on the market. And as it relates to the changes that we sort of profiled in our outlook, we were looking at things like geopolitical tensions all around the world. We've talked a lot about that. The idea that we're in a global election super cycle with 40% of the world's population going to the polls this year. We're in an environment where we have more debt and higher rates, so a fiscal transition that must happen. And then the effects in the wake of the pandemic and the reopening, so new supply chains being created and infrastructure spending, basically. But at the heart of all this, and number one on our list really, was artificial intelligence and how quickly not only is that capability changing, but how that capability is changing the world. So again, we're going to get into it a little bit. Now, recall that when it comes to AI, this is sort of work that we do in the context of investment themes. And so we know, let's say, the themes include productive competition, the new consumer, shifting demographics, securing strategic resources, and the fourth industrial revolution. And when we first put these themes together, I would say AI was sort of anchored in the fourth industrial revolution, the idea that technology is changing the world rapidly and the world between sort of the physical and digital worlds are getting blurred, right? There's a blurring happening, and AI is right in the center of that. But honestly, as we dig into these themes and see them play out, AI is sort of making its way throughout all these different themes, whether it's competition or the way consumption gets done or securing strategic resources. It's kind of everywhere. And in fact, in our Outlook report, we did pen that article I mentioned in our last episode about talking about what AI is, what generative like AI, like ChatGPT, is really all about, the impacts in terms of the economy and the investment opportunities. I just wanted to tease out this time around to say, look, a few interesting data points. The first, essentially each day, 2.5 billion gigabytes of data are created. And AI is learning on all this data. So the more data, the more refined the learning. As we may have talked about last time, McKinsey did a study where they're estimating about 1/3 of all the hours worked, the things being done right now, by 2030 will be automated. And this is a super interesting one. We have quantum computers, but not really in production yet. But to give you a sense of speed, basically it takes a quantum computer 200 seconds to do the calculations that would take the fastest traditional computer today, which is a fast computer, 10,000 years to do those calculations. So this leap to quantum is really quite significant. And, again, we anticipate, think of it as that speed being applied to AI, to deep learning. That just takes it already to a whole new level. Now, as it relates to the market, so think of it as AI and the optimism of AI basically driving the markets. And as I mentioned, we basically surpassed the S&P at 5,000. And what that tells us is, again, the market on a cap-weighted basis appears a bit overvalued. And in fact, when we look at, in this case, the top 10 companies in the S&P 500, and we see how they've performed and also where their PE ratio has gone, basically they're very richly valued, and the bulk of them are these big tech-oriented companies. And then the rest of the companies haven't done quite as well. We'll look at some returns in a second, but bottom line is also the PE ratio is lower. So one would look just at price earnings as a valuation metric and say, okay, these bigger tech-oriented companies are richly valued. But here's the kicker. When we look at growth, so this happens to show essentially 2024 earnings growth estimates and 2025 earnings growth estimates. And the blue bars represent in this case, the Magnificent Seven, those big tech-oriented companies. The orangest bar is the rest of the index, and then the final bar is the index overall. But basically, what we're seeing is that the Magnificent Seven essentially is growing at almost 3 times the rate in terms of earnings to the rest of the market in 2024. And so that's that enthusiasm of technology and AI sort of being embedded in that, and probably their productivity as a result of the effort that they're making there. And we see that's kind of differential, not quite as severe carry forward into 2025. Anyway, when we take that PE ratio and adjust it for growth, it's what's called the PEG ratio, PE divided by growth, where you want a lower number. Lower number means the stock's more attractive. Basically, the Magnificent Seven, you can see, has a much lower PEG ratio than the rest of the S&P 500. So despite the higher valuations, when we look at it and adjust it for this very robust growth, essentially the companies remain reasonably valued on that basis. Anyway, turning to other factors that are going on, recall, and again, we want to think about AI and the drivers of AI, for example, on its influence on the economy. But when we look at our forecast, what we published just over a month ago, we've been calling for a slowdown in economic growth here in the U.S. Still positive, but slower. We've been calling for and expecting more towards the end of the year inflation to cool down towards the Fed's 2% target. And what we would anticipate is that the Fed's going to cut rates 2 to 3 times, 2 to 3 quarter-point cuts, but not do so later in the year. And all of that has been a little bit more muted in outlook than the consensus view. And in fact, what I would say is up until these recent inflation reports, which we'll get to in a second, essentially the market was calling for many, many more rate cuts. Think 6 to 7 quarter-point cuts starting in March was sort of the consensus view. And yet what we've had just recently are a couple sort of more sticky inflation reports. So both the consumer price index and the producer price index came out with levels higher than expected. And that really shook the market. I mean, honestly, stocks went down the day that happened for CPI, and then it's come back up. But when it comes to the Fed view, the view on Fed policy, essentially it's shifted to where the consensus view, this is based on Fed's futures, is that the Fed will cut in June and then just have another 3 cuts through the balance of the year. We still think that's still too optimistic, but again, the market reacted and has kind of calmed itself down in terms of the Fed. And in fact, this is bringing the market towards what the Fed's been saying. So the Fed came in December to a view that, hey, we're likely cut the Fed funds rate in 2024, but they were saying not until we see some good data. Then the markets kind of ignored that. They were just really rallying around the idea that the Fed's going to start debating cuts. And when we look at what happened at the January meeting, the end of January, the Fed reinforced that view that it's going to take longer. And so again, these inflation prints basically have brought market views more in line with the Fed has been saying. Now, as it relates to the economy overall, it's very positive growth, and things have started 2024 positively as well. And in fact, when we look out to various experts around the industry, our own Lindsay Piegza and a bunch of other firms out there, basically everyone has a still positive view for overall for 2024 in terms of economic growth. And again, for our group, the work that we do, we think that might be a little bit overdone, and so we're kind of calling for growth just a little bit below this consensus view. And it's interesting, right? Now, again, back to our topic, I'm sure if you ask almost any expert, people are going to say, hey, we think this is being driven to a good degree by the excitement and the immediate productivity. So almost like the services and capabilities that are being launched around artificial intelligence and what that's going to mean in terms of economic growth. Now, turning to the markets, let's look at interest rates. So basically, interest rates, I mentioned that the market reacted to essentially these firmer than expected inflation reports and sort of the Fed signaling they're going to take a little bit more time. So since the end of the year, let's take that 10-year yield, that sort of bellwether index, basically we ended the year at 3.9. It's gotten above, I think, 4.3 since produces about mid-February. It's down at 4.2. And so think of it as rates up just a little bit higher so far this year. And that's, again, reacting to firmer than expected inflation. And that means that yields on the bond market have maybe gone up just a little bit. And in fact, with that slight rise in yields, that means that the bond market as an investment has actually produced a slightly negative return. So the aggregate index from Bloomberg down about 1.7%. Now, this market performance chart tells the story in 2024, where you can see the New York Stock Exchange FANG Plus Index, which is an index of those bigger tech-oriented companies, up 13.5 so far year to date. And when we look at the equal-weighted S&P, which kind of puts them on an even keel of all the other stocks, the average return year to date is just 1.9%. So that pattern that we saw in 2023 of big tech-oriented companies driving a cap-weighted index up higher because they're so big, and the equal-weighted index not doing quite as well, that same pattern has played through into 2024. And again, I think one can arguably, relate it to this enthusiasm about artificial intelligence. Now, as it relates to the market overall, one good point for 2024 is that we've hit some new highs on the S&P 500. So if you look back at essentially 2023 and 2022, essentially that wasn't happening, right? We had a bear market in 2022. I think it hit one high that year. And then all of last year, we essentially didn't get back to those levels. So we've now gotten back to those levels, and so far in 2024, essentially 11 new highs on the S&P 500. Now, looking forward, recall that as we've talked about for a little while now, we stay focused on the level of interest rates, which we just discussed, and the level of debt. And basically, unfortunately, that level of debt is accelerating. So recall, these are metrics that we've captured since the financial crisis, how much debt has expanded since the financial crisis. And basically, the U.S. federal debt has grown a total of $25 trillion since then. And when we add that with household debt and the different forms of corporate debt, basically we're at $39 trillion in extra debt, again, against an environment where we're sort of seeing, roughly 4 to 5% interest rates as measured by the 10-year Treasury rate, when during the pandemic it was down to 1.2, and the decade after the financial crisis that year was averaged 2%. So we're kind of back to the pre-financial crisis levels again, and what that means, a lot of debt, higher rates that we're going to need to see, essentially a fiscal transition for the consumer, businesses, and the government. Now, interestingly, as it relates to how business operates, and sort of how productive we are, one can also ask the question, is AI going to make us more efficient, be able to grow earnings more, and essentially make more money to be able to service this increased debt and the increased cost of debt that we're experiencing? But again, we think, and part of our reason for a more muted view on the economy is we have to see each segment of the economy basically dealing with this debt situation. Now, as we look forward, of course, we're going to be navigating a variety of dates. We're going to be watching the Fed. We're going to be watching inflation. We're going to be watching the consumer. We have sort of these broader topics like geopolitical tensions and wars going on around the world. I mentioned the elections and fiscal transition. So there's just a lot to be monitoring. And recall that as we do this, it's really to understand which of the scenarios that we modeled out for our outlook ends up playing out. Our base case is that more modestly positive view. There's a bear case that things roll over and we see a recession. And then we may be so far experiencing the bull case side of things where things just keep going in a positive direction. So again, it's very early, but we'll keep an eye on that. We invite you all to continue to check out our work at stifelinsights.com. And we'll be talking about artificial intelligence and all these topics really through the year. Thanks so much for watching this month, and we'll see you again next month. Thank you.